Chapter 8, Part 1. We're going to look at journal entries for perpetual and periodic inventory systems and how we treat trade and purchase discounts. Now, inventory overview. Inventory refers to the assets a company intends to sell in the normal course of business, has in production for future sale, or uses currently in production of goods to be sold. Now, this is always considered their primary source of revenue for the business. Cost of goods sold is the expense related to inventory. Now, goods in transit. Where the goods are on the way to their destination, between the suppliers and a company, or between the company and its customer, accounting for goods in transit depends on when ownership passes. If shipped FOB, which means freight on board, shipping point, title transfers at shipping point. So that means the minute it leaves the company, it becomes the property of the person who purchased it. If shipped FOB destination, it remains with the seller until it's received by the buyer. Goods on consignment. When goods are sold to another company with payment only being received when purchased by a third party, then until the goods are sold, the original seller will include the item in their inventory and the holder of the goods will not. Now we're going to look at a problem to work out what should be added or not added to inventory. So we started we had 210,000 on December 31st, and now we're going to go through these transactions to see if we need to adjust our inventory. Now that's based on a physical inventory. So we had goods shipped to Quack FOB destination on December 20th, and they received on January 4th. Those would not be included in inventory because it's FOB destination, which means Quack will not include them in their inventory until they actually receive them. Goods shipped to Quack FOB shipping point on December 28th were received on January 5th. Now these should be included in inventory because even though they didn't receive them, they took over ownership the minute they left the dock of the person they were buying them from. Now, goods shipped from Quack to a customer FOB destination on December 27th were received by the customer on December 3rd. This is an example of something that should be included in inventory. Why? Because it's not going to be, they do not lose ownership until it's received by the client. Now, goods shipped from Quack to a customer FOB destination on December 26th, and they were received on December 30th. Now, since they were received within the year by the customer, then they would not be part of their inventory because ownership has passed. Now, goods shipped from Quack to a customer FOB shipping point on December 28th were received by the customer on January 4th. Now, here's the thing. It's shipping point, so the minute it left the dock on December 28th, it became the property of the person who bought it. Lastly, goods shipped by Quack to a customer FOB shipping point on December 28th were received by the customer on January 4th. This is a consignment sale and the merchandise cost $18,000. The rule is it would stay in Quack's inventory until it is sold by the person that's holding it for them. So we have an adjusted inventory of $285,000. Now we're going to look at periodic inventory systems. Periodic inventory system. Adjust the inventory account and records records cost of goods sold only at the end of each reporting period and after they do a physical inventory. Records, now we have numerous accounts when you do periodic. We have purchases, we have purchase returns and allowances, purchase discounts, and freight in. And these are considered temporary accounts, and they're zeroed out at the end of the month when a physical inventory is taken. Determine period's cost of goods sold by taking a physical inventory and combining the temporary accounts with the inventory account. Cost of goods sold equals beginning inventory plus net purchases, which is purchases plus freight in less purchase returns and allowances, minus the ending inventory based on a physical count. Now, trade discounts are always ignored. An example would be you bought something for the list price is $100, but because of how many bought, you only pay $60. You would only record $60. Purchase discounts are always given for early payment. Now, we have a gross method where you record the whole amount and you take the discount when payment is made. Or the net amount, you record the discount up front, and then the discount, if it's not taken, is treated as interest expense. So let's take a look at an example of the gross and the net method. In this example, we had items with a list price of 10 and they sold for 6. And we're using periodic, which means every account has to go to purchases, affects the purchase account. So purchases would be 6,000, and we take it 100 times 6. Again, we use the actual price we paid. Then paid within terms, we're going to take that purchase discount. And paid after terms, it would just be accounts payable and cash. Now let's look at the net method. Again, it goes against the purchase account when we bought it, but it's the net amount, and if we paid within terms, it would be the $5,700 and the cash. If we paid outside of terms, we would record interest expense of $300. Now let's walk through an example using the periodic journal entries. So we have beginning inventory of 20,000. We purchased $100,000 worth of goods, 210 net 30. We did our purchases and we booked the net amount. We paid for the freight. It went to freight in. We had returns. It went to purchase returns and allowances. We paid for the balance of the goods after terms, so we had interest expense. And then we sold the goods, and because we're doing periodic, the only thing we can record is the sale. We cannot record cost of goods sold until we do a physical inventory. So what we do is a physical inventory, and it indicates we have goods at $34,300 at month end. We had purchases of $98,000. We have freight in of $1,300. They add to our goods. Then we subtract out the returns, which tells us we have total cost of goods available for sale. Now, to get cost of goods sold, we're going to reverse out our ending inventory based on our physical inventory, and that tells us our cost of goods sold is going to be $80,000. So what's the journal entry going to be like? Well, you have to remember we have to zero out all of our temporary accounts and get the ending inventory up to $34,300, and we have to book cost of goods sold of $80,000. So we're going to zero out, book our new inventory balance, and take out the old inventory balance, and then zero out our purchases, freight in, and purchase returns. So remember, the accounts will be added up and then adjusted for ending inventory to get cost of goods sold. Now we're going to take a look at the perpetual inventory system. Now, we are continually adjust the inventory account for each change in inventory caused by purchases, sales, returns of merchandise by the company to its supplier. Now, these all would be booked to the inventory account. We're going to add freight in plus return by customer minus purchase discounts. So we're continually adjusting cost of goods sold to adjusting the inventory account to get cost of goods sold. So let's take a look at the same problem we did before, and let's do it using the perpetual inventory system. So we purchased goods for $100,000, and you notice in this case we debit inventory. We paid for freight, we debit inventory. We return goods of $5,000, we credit inventory. We paid for the balance of goods purchased after terms. Again, that is the same entry as we did for the other one. Now, sold goods for $110,000 with cost of goods sold of $80,000. We do accounts receivable, sales revenue, but we would book our cost of goods sold. Now, determining ending inventory, we would be looking at our inventory account, which would be continually updated for our purchases, our freight in, our purchase returns, and then we would take out the $80,000, and that would give us our ending balance in our inventory account. Now, perpetual versus periodic. Here's the thing to remember. For perpetual inventory systems, the cost of goods available for sale is allocated by decreasing inventory and increasing cost of goods sold each time goods are sold. For periodic, we allocate cost of goods available for sale between ending inventory and cost of goods sold only at the end of the period after we've taken a physical inventory. Perpetual facilitates the preparation of interim financial statements by providing fairly accurate information without the necessity of a physical count of inventory. Now, periodic requires a physical count for us to figure out cost of goods sold. Perpetual is more expensive because you have to use barcoding. Periodic is easiest, and it's used by small stores where they just go in and count how much they have left. Perpetual involves the tracking of both inventory quantities and costs. Under periodic, all we're going to look at quantities. That ends part 1 of this presentation.